Hi, thanks everyone for joining tonight. I'm Audrey CQ, and I'm here with Melanie Giacomo and Audrey Hutton with Cross Country Mortgage. We're going to go through our 2023 market update and forecast, and then we're going to have a Q&A right after we present. So if you guys can just hold your questions until the end. The real estate market update, it's about 15 minutes, and then the lending portion is somewhere, 10 to 15 minutes as well. So about a half hour of this will be us chatting, and then we're going to be happy to answer all of your questions at that time. If you do need to leave early, just let us know. You can always click your questions in the chat box, and we'll personally respond to you. Make sure you leave a valid email address that you would prefer us to kind of follow up with you at. And again, like I said, we will go ahead and record this and send it out to you after the attending. Okay.
Okay.
So the current market, the changes in the current market work in favor of the educated buyer. And most people say that in real estate, it's driven by supply and demand. But I think here more than anywhere else, the market is tempered by two other things: interest rates and the stock market. So you could say that real estate is supply and demand driven, but it's also tempered by the stock market. Excuse me. So the biggest thing we've been hearing in the news is that mortgage rates have really gone up in the last year. And in fact, this graph will show 30-year fixed and what's been happening in the last year and how interest rates have more than doubled. And so that's really one of the factors that's kind of been a drag on the market. The other thing that we said is that real estate is supply and demand driven, but it's also tempered by the stock market. And this is what has happened with the NASDAQ. This is the dip you see here on the far left, where that was during the pandemic. And then we had this nice big boom from all the CARES Act funding. And then you can see that about in January, the same time last year, the market peaked and then started coming down as the Fed started to raise rates. And so it's down about 30% from its high. So why is this important, and how does it affect our stock market? About 2/3 of buyers in Silicon Valley are at least usually working in tech. And so buyers will think twice about cashing in their Apple stock or Netflix stock. And now this doesn't show the individual stocks, but for example, Netflix was down as much as 75 or 80%. And the stronger companies were down somewhere around 20 or 30%. But this definitely makes the buyers think twice. For instance, they might think, if I'm going to cash in my stock for my down payment, do I do it when the stock is down, right? So ultimately, that has driven the prices down. And this is a view of the last 3 years. This is Santa Clara County single family homes data. So this is pretty much correlated to the entire Bay Area. The prices peaked at $964 a square foot about March 18th. And now they've come down to $860 a square foot. And it looks like what we're seeing is that we're beginning to stabilize, and we'll get more into that a little bit later. So the question that most people want to know, as you've probably been hearing in the news, is all about foreclosures and layoffs. And is this a correction, or is there a crash ahead? So we're going to do a little history lesson, which I think is super cool, because you kind of need to know, how does the market ebb and flow, right? Well, this is the last 40 years of Bay Area real estate. And as you can see, we have had 4 major corrections. And I'm going to tell you what happened in each one of these and what caused them. And that way we can get kind of some idea of what might happen going forward. The first one we had was from 91 to 94. It was our US recession. Now, it didn't start in Silicon Valley, and it was just a general recession. And at the time, interest rates were 8.5% to 9.5%, and home prices drifted down over that 4-year period about 11%. Okay. So where are we today? As we said before, prices peaked in March last year at $964 a square foot in Santa Clara, San Mateo County. And they've come down to about $860 a square foot and are stabilizing. what we can see from our experience is the average correction, it's around 10%. And right now, if you combine those two counties, we're down about 10.7%. But you're probably thinking, what about the crash that we saw in that 40-year chart? Well, in 2008, those prices dropped to like 27%. So the question is, what does it take to actually crash the market? Because you do hear people say like, oh, I'm waiting for prices to crash. That's kind of scary. You don't really want that to happen. But the answer is it's a ton of houses for sale, right? You got to have lots and lots and lots of inventory. And this graph on the left, it's going to show you the supply of inventory. Give me a second here. Let me let in Nikki. There we go. The graph on the left shows the supply of inventory going back to about 2008. And as you can see, we had 14 months of inventory, which is almost 10 times the usual number of homes that are for sale, right? So we're going all the way back from once we got past that Great Recession in 2012, we really have only had a few times where the inventory got more than about 2 months of inventory on the market here locally in the Bay Area. And then prices began to mellow out a little bit. But where we are right now is really nowhere near what has been to cause that kind of a crash. So recession right now, right? In fact, 3/4 of the global CEOs say that we are in a recession, or we're going to be in one in the next like 12 to 18 months, right? And the question is, does the recession mean that we're going to have a housing crash? So this is a look at the last 6 recessions. Half of the time we had a recession from the time the recession started until it actually ended. Half of those times the prices actually went up. And the other half of the time, we had a slight correction, and you can see those there. Now, we did have the great crash of 2008, but like we already talked about, the fundamentals to create a great crash would take a ton of houses for sale. So as we saw in the last slide, we just don't have that kind of inventory like we did back in 2008, right? And so you might be thinking, or you probably heard in the news too, is, well, what about all these layoffs, right? Everybody's freaking out about the tech companies are laying off people, right? So to quote the Morning Star, the Silicon Valley is the epicenter of the tech industry with massive layoffs announcements, but the experts are remaining hopeful despite acknowledging the very real disruption that those workers have had and been affected by. In fact, the unemployment rate actually went down in December in spite of all these layoffs. So we've had more new jobs created than actually people laid off, resulting in a drop in Silicon Valley's unemployment rate from 2.3% to 2%. Okay. So from history, we can conclude that it does take the unemployment rate to hit about 8% before it actually starts to put pressure or downward force on the housing market. As we can see here in this chart, while the U.S. is at a 3.3% unemployment rate, Santa Clara County, San Mateo County are even lower at 2%, right? And the question is, will prices go down further, right? I mean, people are always, is it going to go down? Is it going to go down? They're always looking for that opportune moment to hit the bottom, right? And I'll remind you of a quote that we started with, that real estate is a supply and demand driven, but it's tempered by interest rates and the stock market. So then what's happening with supply? What is happening with this supply? This is looking at the last 3 years of supply in Santa Clara County, the ups and downs that we call seasonality. More houses come to the market in the summer and fewer go on the market in January. But overall, as you can see here, the trend, you can see this trend, it peaked in July and it's been trending down in January. So Melanie, why don't you take over here and kind of grab the next few slides and go over that with everyone.
Yeah, of course. Yeah. So we'll start with this quote from Lawrence Yun, the chief economist of National Association of Realtors. He states, the year ahead, we will see significantly fewer sellers come to the market as only the most motivated are willing to take on a mortgage rate at a rate and payment much higher than they have today, which makes sense, right? So then what's happening with rates? So because we see a slowdown and we see inflation comparisons starting to be more and more favorable, you'll start to see that inflation number move lower and lower as well. And as a result, mortgage rates should move similarly downward on a downward trajectory, probably giving us 5 or below 5% by the middle of the year. So this is looking at interest rates for the last year. You know, we saw them basically double, and now it looks like they're going down. So this does concur with what those chief economists are expecting. And then here we're looking at the forecast from the top 4 mortgage indexes. So Freddie Mac, Fannie Mae, Mortgage Bankers Association, and National Association of Realtors. So these are mortgage rates projected for 2023. And so the first quarter they're projecting will be about 6.35%, which we're actually beating that right now. For quarter 2, they're saying may drift down to 6.05%. Quarter 3, 5.90%. And quarter 4 of 2023 down 5.73%. And you know, note that these are for 30-year fixed quotes. So demand, right? So supply and demand. So what's happening on the demand side then? So the upcoming months should see a return of buyers as mortgage rates appear to have already peaked and have been coming down since mid-November. So here is what we're seeing in the stats. This shows the amount of homes coming to market versus the amount of homes being absorbed. As you can see, the amount of homes coming to the market in the 3 million plus range is 12 new homes. And 20 of those, 20 homes are going into contract. At the next range of about 1.8 million, 14 new homes came to market and 21 went into contract. At the 1.25 million, 18 new homes came to market and 26 went into contract. Then if we look at the 800K range, 25 new homes came to market and then 24 of those homes went into contract. So what does that mean? Meaning more homes are going into contract than are actually hitting the market, which means that there are a lot more buyers coming into the market now. So then what's happening with the stock market right now? The NASDAQ, which went up and started to come down a little bit, does appear to be finding some support here, as you can see. So it's no longer in free fall. So we've got rates are drifting down, inventory is drifting down, and we've got a stock market that's finding stability. So where is the market headed then? So here's our forecast for 2023. Interest rates will decrease as inflation comes down. The demand will increase as interest rates come down, which we're already starting to see, right? The buyers are coming back and they're coming out. So supply will be lower as fewer sellers will list their homes. And then prices will likely rise 3 to 5% from this current market bottom that we're in. So in summary, Bay Area real estate has gone on sale 4 times in the last 40 years. Right? So as we've seen in this chart, each one of these times are when real estate has gone on sale. And this is the 5th time. So is this the right time to buy for you? Well, the question is, how long do you plan to live here? That's really the question, right? Could the market go down further? Maybe. Is it going to crash? Not likely. But if what we see in the cycle of those last 40-year chart, then if you plan on living here for more than 5 years, then buying is still a safe and smart move. But you might be thinking, well, what if the worst happens and it crashes? Meet Brad. So Brad is an agent in our office here at Real Estate Experts. Brad bought a house in 2008. Now, it's kind of a sad story, but it's also a good story. Brad bought his house at the absolute worst time. So as you can see here in this red circle, he bought August 27th, 2008, like literally at the peak. So you see here, Brad bought his house for $810,000. As you can see again, it's right at the peak. And 4 years later, it had dropped 27% down to $591,000. And he was crying because his house that he had paid over $800,000 for was now worth less than $600,000. So 5.5 years later, it completely recovered. You can see this line here showing that. And by 2017, it actually doubled to 1.6. And today, Brad is smiling because his house is now worth over $1.7 million. So fun little story there. And so really what you need to know is that you need to be prepared to win in this market, and you need to be informed. So being prepared and being informed is really important, and that's why you're here, right? So we're here to help you, keep you informed, keep you prepared at all times, and give you those market updates along the way. So, thanks for listening to our little spiel. And now we have our preferred lender, Audrey Hutton here. She's going to discuss the lending side of things, rates, creative financing, and what options you have for financing a home in 2023. So Audrey, take it away.
Thank you. Now I'm ready for the next slide.
Cool.
Awesome. I am so pumped up after seeing Brad's story. I want to go buy a house right now. But no, thank you guys so much. As you can see, it takes a lot of data to put everything together. And you're with the best of the best. Audrey and Melanie are some of the best agents that I work with. So I'm honored to be here as your guest speaker and preferred lender. So I wanted to chat with you guys about most of the questions that we get when we do a pre-approval, because I think this will be really helpful. Seems like our audience is a combination of first-time home buyers, experienced investors, everybody in between. So we'll go over some of the basics with how do you actually get a loan, how are banks and investors looking at buyers right now, and some creative programs around those, so that no matter where you are in the market, whether it's the first time or multiple investings that you've already purchased, that there's going to be options for you. So we're just going to do a quick overview of the credit, the capital, and the capacity. What does that really take to do a loan? And the next one, thank you, Melanie. So first with the credit, just to do a really quick overview, the credit score is basically pulled by all three bureaus, and there's multiple different things that go into that credit score. So that's a whole other course that we could be doing to dive into the specifics of that. But why it's important is they're really comparing all of your debts to your maximum. So for example, if you have a credit card that has a maximum of $50,000 available, it's going to hurt your score typically if you're above 30% of that. So ideally, to get the best credit, you want to keep the amount that's charged up on your potential debts at the lowest possible. And there's other things like late payments or collections or public records like bankruptcies. All of those things could impact your credit. So it's important because all three bureaus use that as a base for lending. If you show that you're responsible for lending, then you're going to have more banks that say yes to you. And we also have some creative options where if you have a bump in your life, there's so many people that have gone through divorce or have gone through a huge medical issue and haven't been able to keep up with bills. So there's definitely some solutions for those things. Credit is really mainstream for those programs, but there's definitely programs to help outside of the mainstream as well. And so that's everything that kind of determines your score. Is they're looking at the history. In this area as well, we have a lot of first-time home buyers that are not US citizens. And that's really key because every bank will give you a different answer, and the credit history is going to be really key. So I will make a note if anybody's interested or curious that yes, you do not have to have any US credit in order to buy a home. You can literally buy a house as a foreign national and not have any US credit at all. So next slide, please. So comparing the capacity, I think this is something that's really great just to understand the basics of how the traditional lenders are looking at qualifications. So you can just take an example of monthly income. Let's just say an hourly salary, somebody's making about $2,600 a month. I know these are just some baseline numbers because we lend in all 50 states, so we have people from everywhere looking to buy. So we'll look at the income and then we compare the debts. So let's say somebody has a credit card for $50 a month and they have an auto loan for $200 a month. So the new house payment, let's just say add on another $800. They're comparing all of the debts added up divided by the income. So in this case, you're looking at a debt to income ratio of about 40%. So most traditional lenders, if you're staying with a conforming loan amount, which in the Bay Area, it's $1,089,300 is conforming. So we're literally in the millions for conforming, you guys, which is crazy. So you can actually go up to 50% of your income with the conforming loan amount. If you go above conforming, so that means if your loan amount is above that $1,089,300, then typically most of your big banks want to see your debt to income ratios no more than 43% for somebody that's owned a home before and has shown that they can make mortgage payments. If it's a first-time home buyer, some of those big banks actually restrict you to 38%. So I kind of go through those details because I want everybody to understand that there's not a one mold fits all. Every bank really is different. Each bank follows typically the government-based guidelines, but then they put their own overlays on top of it with what risk they're willing to do. So traditionally, we'll look through, at a time of pre-approval, we'll look through all the banks for our clients just to see who fits best with each scenario. And next slide. And looking at the collateral. So there's some things that people have to prepare for in looking at buying a home. So obviously, depending on the program, giving some examples, there's also first-time home buyer financing, which there are programs that can literally give up to 100% financing. Some traditional and more familiar names are going to be your FHA, which only require 3.5% down. VA financing, if you are a veteran, you are handsomely rewarded, and rightly so. You can literally not have to put anything down and have all the closing costs potentially paid for as well. Your traditional conventional programs, you can potentially put as little as 3% down for the high balance. If you do go up to that $1,089,300 in this area, that is considered a high cost area. So it is 5% down. And then it's generally recommended to set aside anywhere from 1 to 3% in cash to close, just to cover mainly taxes, insurance, third-party fees, etc. So that's just an overview as far as what you can anticipate as far as cash to close and investment when you're buying a home. And next slide. So this is probably the holy grail of financing. If you guys take a snapshot of anything in the finance section of this, take a little snippet of this. So these are all the do's and don'ts that we recommend when it comes to financing and getting a home loan, and things that we see that could potentially impact you getting a home. So obviously the do's, definitely pay your bills on time. You want to keep that credit score the same, because when we do a pre-approval, we're looking at all the information, how it looks at that time. So if we do a pre-approval for somebody and then all of a sudden you have late payments, that's going to change your score, which by the time you get in a contract, that will impact the results for you. And we always recommend just keep using your credit card as normal, because if you're using it when we do the pre-approval, then you're just using that normally in your daily life. And we also recommend that you do disclose all of the income and debts. Sometimes we have people that say, hey, this is my main job, but then we look at their tax return and they have, you know, several more thousand of income on there, and they forget to tell us, oh yeah, I have a side job and I pay taxes on it. So any little thing that we can do to help you qualify, we will find it in that documentation. So also things like child support, alimony. Sometimes people have disabled children that they're taking care of and they receive income for that. So there's a lot of different types of income that we can use to help a family household qualify. And so during the pre-approval process, we ask all those proper questions just to make sure that we're not leaving anything on the table, and we help people remember things that they might forget to tell us just with the basic government application. So we always make sure that people provide the documentation that we ask for your protection, because a lot of lenders, and you know, just for the ease of things, especially nowadays, you can go online, you can play with figures, but you guys, it's really not accurate. And ultimately it's your money on the line. So we do require for everybody to send in their documentation to us, just so we can make sure that you're protected. I know if you guys are anything like the majority of people, you don't want to risk your money. You want to make sure that it's not frivolously lost in a transaction. And unfortunately, we get a lot of emergency calls from people who are pre-approved. So when you're going through that pre-approval process, it is very valuable to have that lender look through every piece of documentation to make sure that everything is up to par. And definitely be upfront about any credit card debts, any debts that you have, because believe me, the government will find it. And they usually will find out about it at the very end, right when you're expecting your keys. So if we know about that information right up front, it just helps us problem solve with you. There's some people that we chat with and will recommend, hey, just do this and this, and we'll wait 1 month and then it'll fall off and then you'll qualify. So there's different things. There's a lot of reasons as to why you want to get that pre-approval done up front, so that way we can make sure that you get the results that you want. And sometimes it's just massaging of a few little details that nobody would ever know unless you hear it from a professional loan officer. So, definitely the last one, let us know if you have any questions, especially right now, there's a lot of people changing jobs. It may or may not impact people. So going to the don'ts, that's the number one thing is, let's just give an example. If a lot of people in the Bay Area, for just a good example, they're on commission or they have heavy RSU income. If you're switching jobs, there are some banks that will allow that and some will not. So I'll give Wells Fargo, for example, absolutely will not let you change jobs and use commission income. So you have to be at the same job for 2 or more years to use that same commission. Chase, however, is pretty flexible. So that's where, again, we weed through to see what bank somebody needs in order to qualify. So Chase will allow somebody to continue to use the commission income even if they've been there for a month, as long as they show a history, relatively similar job situations. So that's where we can help you guys, but don't not take a job offer just because you're trying to do this. It's just all about communication. A lot of times we'll just have a little update with somebody and we'll chat about the new job, just make sure it falls in the same line of work. We'll talk about the structure and I'll run the numbers and make sure that it doesn't impact the pre-approval. But the job is the number one thing that we see right now. It says, don't move. We put that on there just because a lot of times people forget to tell us that they have moved, that things have changed on their applications, that they, have signed a new lease, or maybe it cost them money to break out of that lease. And we will account for all of that for you guys when we are looking at your cash to close. So getting into any leases and that have really high, it will add debt to your cash to close if we have to break that. And it's not necessarily the worst thing. We do prepare. Sometimes you can't time everything perfectly. So we'll also do an analysis just so that you know if you have to pay to break that lease, what your break even point is. And 9 times out of 10, it's worth it to break the lease to get into the home when you find the right home. So don't apply for new credit or loans of any kind. This is very crucial. It's kind of a joke, but it's not really. How many people have we had that have applied for a Tesla and they've been waiting 8 months for it? And then right when they're buying a house, that's when the Tesla arrives and that's when the payments start. And they have forgotten all about it. So all of a sudden we have an $800 a month payment hitting their credit debt, and it does impact the pre-approval. So if you guys get pre-approved and there's something not showing up on your credit report yet, if you do apply for any credit cards and charge of debt after the fact, all of that does come into play, and we definitely need to know about it just so we can see if it impacts you. So the easiest thing is, if you know that you're buying a home, just correspond with us and we'll let you know how heavy the impact is, but just don't do it. There's no need to do extra frivolous shopping and, save the money for the down payment. It's all good. So don't co-sign or become a co-borrower on any other loan. This is heartbreaking because I've seen this. Really sweet people co-signing for family members and they don't know how it impacts them. So, again, these are individual bases that we can see. If you can afford to co-sign and help your family members, we're not telling you to not do that, but it's just all about running the numbers. Sometimes people don't understand that if you do co-sign for somebody else's mortgage or car, that does actually consider you as a co-borrower. It will show up on your credit report. And if they default, they'll be responsible in full for that debt. So we have to count that. There are little caveats to that. So if somebody has made payments for 12 months or more than 12 months, there are certain lenders that will excuse that debt, but it comes with heavy documentation. So everybody just has to be cooperative. And don't make any major changes to your asset structure. So this means if we do a pre-approval and you have enough money for a 5% down or 20% down, and that's how we pre-approved you, if you end up spending that money on anything and you don't have the cash anymore, then that means that you're going to be short cash to close. So you just want to try to keep everything in a similar structure. And the last one, don't make any cash deposits into your bank account. A lot of people are unaware that the government does not let you use cash to buy a house. So if you have that mattress money, you have it stacked up under your bed, it's a great thing, and roll around in it when you can, you guys, but you can't use it for the purchase. So we're going to strategize with you and help you get that money deposited into the bank, wait a couple months so it's seasoned money, and then help you buy. So classic do's or don'ts. That happens more than you guys may think. Pretty funny. Next one. All righty. So now that you guys know how the banks look at your information, how they qualify you, and what's potentially possible, I think it's really great to chat about all of these interest rates, all the movement, and just kind of summarize what Audrey and Melanie chatted about. Because if you guys reacted like how I did, I love seeing the data and I want to buy a house. So I'm an investor as well. So everybody sees that this is a really good time to buy. It's an opportunity there. So you can't always have everything perfect, right? So if you have the lowest possible purchase prices and you have the lowest possible rates, everybody and their brother would be buying during that time. And we have seen that. And that's why it got so competitive in the Bay Area that it pushed the prices right up. So if you think about it this way, you're going to be paying either way a little bit more in either direction. Either it's going to be so competitive because everything's so great that you're going to be overpaying for the purchase price, or you're going to be paying a little bit more when the rates are high. So there's a couple solutions on the lending side that we have come up with as an industry. I wish I could take credit for it, but pretty much every lender is offering these programs. So it's really great for you guys to see this. So how do you defeat these high interest rates? There's something called buy down. And so what that means is this is a program, honestly, that has been around forever, but it is so rarely used because, as Audrey and Melanie have pointed out, this is really only the 5th time that real estate is on sale. So you're never going to see these programs when real estate is not on sale. And what a buy down means is that you have a little bit of stagnation with the available properties on the market. So you have sellers where their properties are sitting there for a little bit because the interest rates are much higher, that either a lot of people don't qualify or they're waiting for the rates to come down. So you have a seller that's very motivated and they might be willing. It takes a little negotiation. So you do have to have an amazing real estate agent. So definitely Audrey and Melanie know the negotiations like the back of their hand. And that is exactly what it takes, because a lot of agents don't know how to negotiate the buy down. It's very delicate because what they have to do is negotiate for the seller to give you a credit that is going to buy that interest rate down for you. So it's actually the seller that's going to be paying the difference. So next slide, I'll show you guys a little bit how this works here. So we'll just use an example. We just used a 900 purchase price just to keep everything pretty basic and easy. So let's just say the down payment is $45,000. So you have an $855,000 loan amount. These are not rates for today, but we're just using this for general purposes, roughly around 7%, because as you guys saw in the graphs, even though rates are expected to trend down, and we have seen that, there are still hikes and lows as we go through the quarters here. So essentially how the buy down works is that seller will give a credit, and it's called either a 3-2-1 buy down or a 2-1 buy down. And really all the differences is that the seller will either credit 3 years of difference in payment or 2 years in difference in payment. So let's just say if the rate was 7% and that's the paperwork that you signed and you got in, that means that the very first year, your rate would actually be 5%. So this is on the 2-1 buy down. So your rate would actually be 2% lower than what the standard rate would be. So all your neighbors and friends are getting a 7% rate. But if you have Melanie or Audrey negotiate the buy down for you, the 2-1 buy down, then your rate would actually start at 5%. So you're getting 2% lower than the average start rate would be. And the next year would follow suit. So the next year it would go up 1%, so you'd be at 6%. And then that third year, you would actually be at the normal rate. So the difference is you can see the monthly savings in year one is about $1,098 a month. So total savings would be $13,000. In year two, the total savings would be about $67. So it's a pretty huge difference. And really the advantage for you guys as the buyer is it helps you get in to lower that monthly payment. And really, because we know the interest rates are artificially high because they're trying to curb inflation, and they literally have stated, you have Fannie Mae that has made announcements that they absolutely will be dropping rates as soon as that's curbed. And given the projections that rates are going to be roughly in the 5s and 6s potentially, nobody knows the exact day, but it's just going to have to follow all the reports that come out. So you know that you're going to be refinancing. On average, even when we're not in a market like this, the standard home buyer refinances between 1 to 3 years. So if you guys are listening and you're a homeowner, you're probably one of those people where you have refinanced. I know everybody that's owned a home has refinanced. So in this type of market, you're pretty much guaranteed that you're going to refinance just because of where we're at with getting in with higher rates. The advantage is that if you get in right now before everybody else, so keep in mind the magic right now, you guys, and it's almost over because it's starting to get really competitive again, is that if you get in now when the interest rates are higher, you're beating everybody else out, either the people that can't qualify or the people that are waiting with the masses. But if you get in with the higher interest rates, that means that you're getting a better house price because it's not quite competitive yet. This window is going to be slowly closing because, as Audrey and Melanie showed you guys, it's going to get really competitive in cycles, and there's going to be a lot more movement. As soon as those rates drop, that's when everybody else jumps in the market, and that's going to push the prices up. So it's almost better to get in when the interest rates are higher and the purchase price is a little bit lower and can be negotiated, because that sets your tax base. That you can't change. You can always change the interest rate, and you know the rates are going to come down. So that's the magic of, if you're going to pick one because you can't have them both low, I would much rather have my permanent tax base lower, get in for a couple months or a year, and then refinance that, and then you have a low payment and low tax base. I cannot express to you guys what a golden moment this is. So next slide. So essentially, this is just going through how to calculate that 3-2-1 buy down. And you can tell I'm so super excited that I already told you guys how to calculate that. So we are going to skip to the next slide. So essentially, buying now means that you guys can be saving later. So as I mentioned, getting in with the higher interest rate now, and then you can save later. So in the next slide, basically, most lenders have a program. It's literally called Buy Now, Refi Later, because there's so many people in this spot. So essentially, all you have to do is 2 steps. Step 1, you buy a home, you find a house now and you buy, and you close that purchase loan with us as Cross Country Mortgage. This is a program that we offer, but like I said, I'll be honest, a lot of lenders are offering this. So this is not something that we just came up with. This is just an industry, pretty standard. But what Cross Country Mortgage does is we do give you an eligibility certificate, because we guarantee that in step 2, we will refinance you guys later, as long as you do it by December 31st of 2025. I know some lenders are cutting that off in 2024. We're actually doing it through the end of 2025, where we will actually cover the lender costs. So basically a free refinance. And that is just to incentivize, to show people the importance before everybody and their brother starts to buy again, that you really do want to get in now, just buy now, and then you can always refinance later, because we want all of our clients to really take advantage of getting in the market before it gets into a frenzy again. So that is the conclusion of the financing piece of this. And I know Audrey and Melanie and I wanted to go through questions if you guys had any for us. But thank you guys again so much for, I'm still very inspired by that market update, and it all tied in pretty well. So